Leading analyst Craig Moffett has expressed skepticism regarding Apple's potential shift of iPhone assembly from China to India, as reported by the Financial Times. Moffett argues that while moving production to India may alleviate some tariff-related costs, it does not address the broader challenges posed by a global trade war, particularly since significant components would still be manufactured in China. He emphasizes that Apple's supply chain remains deeply entrenched in China, making a complete transition to India difficult and potentially ineffective in solving the core issues. Moffett has adjusted his price target for Apple shares to $141, down from $184, signaling a bearish outlook amid concerns over valuation and external pressures like tariffs and slowing consumer demand. Despite Apple's robust balance sheet and strong consumer base, Moffett highlights the potential for demand destruction due to increased handset costs, as major U.S. carriers like AT&T, Verizon, and T-Mobile have indicated they will not absorb additional tariff costs. This scenario could lead to longer device replacement cycles and reduced sales estimates for the coming year. Furthermore, Moffett notes that the backlash in China against U.S. tariffs could further impact Apple's market share, with local competitors gaining ground.
Lockheed Martin's recent earnings report showcased a significant beat over Wall Street expectations, with a reported $7.28 per share profit on $18 billion in sales, surpassing the anticipated $6.31 per share on $17.8 billion in sales. Despite this impressive performance, the market's reaction was tepid, with the stock price seeing only a modest increase. A muted response can be attributed to the company's modest year-over-year sales growth of 4% and concerns over the quality of earnings, as operating cash flow declined to $1.4 billion and free cash flow dropped to $955 million from $1.3 billion the previous year. This discrepancy suggests that for every dollar of GAAP profit reported, only 56 cents was backed by actual cash profit, raising questions about the underlying financial health. Lockheed Martin's guidance for 2025 further contributed to investor caution. The company projected revenue between $73.75 billion and $74.75 billion, aligning closely with Wall Street consensus. However, anticipated earnings of $27 to $27.30 per share fell short of the consensus estimate, indicating a potential miss later in the year. On a positive note, Lockheed expects a robust rebound in free cash flow, targeting $6.6 billion to $6.8 billion, a 26% growth from the previous year's $5.3 billion. This optimistic free cash flow forecast, coupled with a 2.8% dividend yield, positions Lockheed Martin as a potentially undervalued investment opportunity, trading at approximately 16.2 times current year FCF, which may appeal to investors seeking growth in the defense sector.
Bitcoin is poised to outperform other major cryptocurrencies like XRP and Ethereum in the coming year due to a confluence of macroeconomic factors. With Bitcoin accounting for approximately 63% of the entire crypto market cap, its relative stability and institutional backing make it a go-to asset during periods of market uncertainty. Recent volatility, driven by aggressive tariff policies under the Trump administration, has led to a flight to quality, with investors moving away from riskier altcoins towards Bitcoin. This trend is expected to continue as long as the macroeconomic environment remains unpredictable. Additionally, the geopolitical landscape has prompted investors to pull money out of U.S. markets, including both stocks and treasuries, due to declining values. This has weakened the U.S. dollar, further enhancing Bitcoin's appeal as a hedge against currency devaluation. Moreover, the inflationary pressures resulting from tariffs are likely to push Bitcoin's price higher. Bitcoin's fixed supply makes it an attractive hedge against inflation, which is anticipated to rise due to increased costs from tariffs. These factors collectively suggest that Bitcoin will maintain its dominance in the cryptocurrency market, potentially extending its lead over XRP and Ethereum in the months ahead.
A recent Lending Tree survey reveals a significant uptick in the use of Buy Now, Pay Later (BNPL) loans for grocery purchases among Americans, highlighting financial strain amid persistent inflation and high interest rates. The survey, conducted with 2,000 U.S. consumers, indicates that 25% of BNPL users are now financing groceries, up from 14% in the previous year. Additionally, 41% of respondents reported making late payments on BNPL loans in the past year, an increase from 34% the year before. This trend underscores the growing financial pressure on consumers as they increasingly rely on BNPL services to manage essential expenses in an uncertain economic climate. The rise in BNPL usage for essentials like groceries reflects broader economic challenges, including inflation, high interest rates, and tariff concerns. Although BNPL loans offer an interest-free alternative to credit cards, they pose risks, particularly when consumers juggle multiple loans simultaneously. The survey found that 60% of BNPL users had multiple loans at once, with nearly a quarter holding 3 or more concurrently. This financial strategy, while providing short-term relief, can lead to significant fees and financial instability if mismanaged. The findings align with recent warnings from major companies such as Walmart and Delta Airlines about weakening consumer demand and potential economic downturns. As the economic outlook remains uncertain, consumers and financial analysts alike are closely monitoring these trends for further signs of financial distress.
Nvidia's stock valuation has recently approached parity with the S&P 500, a surprising development given its anticipated high-growth trajectory. The key metric in focus is the forward price-to-earnings (PE) ratio, which estimates future earnings and is currently at 22.4 for Nvidia, compared to the S&P 500's 19.8. This metric suggests that Nvidia is only slightly more expensive than the broader market. Despite Wall Street analysts projecting significant revenue growth of 54% in FY 2026 and 23% in FY 2027. However, forward PE ratios rely on projections that are inherently uncertain, and Nvidia's valuation might be temporarily suppressed pending upcoming earnings reports. Despite concerns surrounding potential tariff impacts and mixed reports on chip demand, Nvidia's GPUs remain critical for AI model development, suggesting robust future sales. Recent statements from Taiwan Semiconductor Manufacturing Company (TSMC), Nvidia's key supplier, indicate no immediate reduction in chip orders, contradicting some market fears. As a result, Nvidia's current stock price may present a buying opportunity for long-term investors willing to withstand short-term volatility, with a potential for significant market outperformance over the next 3 to 5 years. Nvidia remains a compelling prospect for those with a high risk tolerance and a focus on future growth.
Goodwill Industries, a nonprofit organization known for its thrift stores, recently made headlines when a donated painting by French Impressionist Édouard Léon Cortés was sold for $40,000. The painting, depicting a Parisian market scene, was initially overlooked by the donor, who was unaware of its true value. This unexpected windfall was used to fund Goodwill's Excel Center, a free high school for adults over 21 in Baltimore, addressing educational gaps for an estimated 80,000 individuals who did not complete high school. This highlights how Goodwill's operations not only provide affordable goods but also contribute significantly to community development. In a broader economic context, Goodwill CEO Lisa Rusiniak noted that tariffs imposed by former President Donald Trump, particularly a 145% tariff on Chinese imports, could indirectly benefit second-hand retailers like Goodwill. As these tariffs increase the cost of new goods, more consumers may turn to thrift stores for affordable alternatives. This shift not only supports Goodwill's mission of reducing landfill waste through a circular economy, but also potentially increases foot traffic and sales in their stores. This scenario underscores the complex interplay between international trade policies and domestic consumer behavior, offering unique opportunities for nonprofits to expand their impact.
The fixed income market is undergoing notable shifts as the Federal Reserve cautiously proceeds with its rate-cutting cycle. This environment is further complicated by the introduction of broad-based tariffs and rising geopolitical uncertainties, which have increased market volatility and made inflation and growth forecasts more challenging. Despite these headwinds, elevated yields and strong credit fundamentals present attractive opportunities, particularly in the investment-grade and high-yield sectors. These conditions underscore the importance of careful issuer selection and active management to capitalize on valuation adjustments that could enhance potential returns. Principal Financial Group, a global leader in investment management, highlights the significance of these developments for investors. With $519.3 billion in assets under management, Principal Financial emphasizes the need for strategic positioning in response to evolving policy dynamics and market conditions. The firm's analysis suggests that while risks remain, the current landscape offers selective opportunities for those adept at navigating the complexities of the fixed income market. This approach is crucial for investors seeking to optimize their portfolios amidst ongoing economic and geopolitical uncertainties.
Tesla stock has seen an unexpected rise despite the company retracting its annual guidance, following a challenging quarter marked by a 13% drop in deliveries and a 20% decline in auto revenue. CEO Elon Musk's renewed focus on Tesla, along with ambitious plans for autonomous driving and a robotaxi service, have contributed to the stock's rally. However, significant challenges remain as Tesla's core automotive business struggles and its market share diminishes in the face of rising global EV sales. Musk's political ventures and time spent away from Tesla have also impacted the brand's image, potentially alienating key consumer demographics. Despite these hurdles, Musk is pushing forward with plans to launch a robotaxi service in Austin, Texas, by June. Though skepticism surrounds this timeline due to Tesla's current Level 2 automation, which falls short of the Level 4 required for autonomous taxis. The company's vision-only approach to autonomous driving has yet to prove its reliability, further casting doubt on the feasibility of Musk's plans. Tesla's stock remains highly valued, trading at a forward P/E ratio over 100 based on 2025 estimates, which is significantly higher than its U.S. auto peers. Analyst sentiment reflects caution, with Roth Capital revising Tesla's Q3 2025 earnings per share (EPS) estimate downwards from 64 cents to 53 cents. Cantor Fitzgerald and Royal Bank of Canada have also reduced their price targets for Tesla, indicating concerns about the company's near-term performance. Tesla's recent quarterly earnings report revealed an EPS of 27 cents, below the consensus estimate of 53 cents, and revenue of $19.34 billion, missing the anticipated $22.93 billion. Despite these challenges, Tesla maintains a strong market capitalization of $916.55 billion and continues to attract substantial institutional interest, with hedge funds holding 66.20% of its stock. Mixed analyst ratings, ranging from sell to strong buy, underscore the divided market sentiment on Tesla's future amidst an increasingly competitive EV landscape.
Webull, an online brokerage firm, recently went public through a merger with a special purpose acquisition company, SPAC, on April 11th, seeing its stock price initially soar from $16 to a record $62.90, before settling back to around $23. Founded in 2016 as Hunan Fumi Information Technology in China, Webull has since restructured as a U.S.-based company, now headquartered in St. Petersburg, Florida. Despite its U.S. base, Webull faces scrutiny from state attorneys general over alleged ties to the Chinese government, posing potential regulatory risks similar to those faced by other Chinese-affiliated apps like TikTok. Webull's business model mirrors that of Robinhood, offering commission-free trades through a payment for order flow (PFOF) model. While Webull boasts a more geographically diverse presence across 14 markets, it remains a smaller player compared to Robinhood. With 4.7 million funded accounts and $13.6 billion in customer assets versus Robinhood's 25.2 million funded accounts and $193 billion in assets. Despite an 18% growth in its registered user base and a 66% increase in total assets in 2024, Weeble's revenue remained flat at $390 million, and its operating expenses rose, leading to a significant drop in adjusted operating margin. With a market cap of $10.8 billion, Webull trades at a high valuation of 28 times last year's sales, compared to Robinhood's 13 times sales, suggesting overvaluation and potential caution for investors.
Geopolitical tensions between India and Pakistan, coupled with fears of a trade war, are weighing heavily on investor sentiment in India, leading to a downward revision of GDP growth projections. Market expert Ajay Baga anticipates a geopolitical event that may impact Indian markets in the coming weeks. Despite these tensions, global markets, including Asian and European markets, have shown resilience with improved risk sentiment. The U.S. markets have also seen a recovery, particularly in big tech stocks, referred to as the Magnificent Seven. However, uncertainties remain regarding U.S.-China trade discussions, with conflicting narratives from both sides. The Reserve Bank of India, RBI, projects a GDP growth of 6.5% for India, but international bodies like the IMF and World Bank have lowered their forecasts to 6.2% and 6.3%, respectively. The geopolitical tensions and potential for increased defense spending are expected to buoy defense stocks in India. The sector is likely to outperform the market as India seeks to enhance its defense capabilities amidst elevated global geopolitical risks. Foreign institutional investors, FIIs, have shown renewed interest in Indian markets, particularly in value-based sectors and mid-cap and small-cap stocks. Despite recent market volatility, India is perceived as an attractive investment destination, offering opportunities for FIIs to capitalize on market corrections. The anticipated rate cuts by the RBI, coupled with a favorable monsoon forecast, are expected to lend support to the domestic economy, although the geopolitical landscape remains a critical factor to monitor.